today we are going to solve question May 2023 paper question number 3. Vulture Capital is considering the purchase of Magna Bolt. Calculate the ratios. Okay, they have given some information about the balances available. Now we have to calculate the ratio. So first one is the gross profit as a percentage of revenue. The formula is gross profit over revenue. So that is equal to revenue minus cost of sales divided by revenue times 100. Okay, so times 100. So this is the percentage. Okay, we have to calculate. Now the revenue is going to be equal to, we can see that it is 500. Okay, so revenue minus cost of sales is around 350. So 350 divided by the revenue is 500. So, and then you calculate the ratio, okay, and convert it into percentage. So that is equal to 150 over 500 times 150 over 500 times 100. So that value is going to be equal to 30 percentage. So this is the gross profit as a percentage of revenue. Next we have the inventory turnover. Inventory turnover, the formula is cost of inventory, okay, cost of inventory by cost of sales divided by average inventory. Okay, the average inventory is going to be equal to opening inventory plus closing inventory by 2. This is the formula we have. Now we know that there is a closing inventory given, 40 is given. Okay, so cost of sales is given 350. So let's calculate the opening inventory. The opening inventory is going to be equal to COS is equal to opening inventory, okay, plus purchases minus closing inventory, okay, minus the closing inventory. So from this we have to calculate opening inventory. So let's replace this. Cost of sales is 350. So that is equal to the opening inventory, okay, opening inventory, then plus purchases is going to be around 300. So write 300 minus the closing inventory is 40. So this means opening inventory will be equal to, okay, 350 minus 300 minus 40, that is equal to 90. Okay, 90,000. So that is the cost of the opening inventory. Now let's calculate here. You can ignore thousands because it doesn't affect so much, they get cancelled out. So the cost of sales is 350,000. You can put 1000 or you can ignore also. Okay, just use the 3 units. Then 350 divided by 90,000. Opening inventory is 90,000 plus, okay, closing inventory is 40,000, the whole divided by 2, okay, the average inventory, okay, and then that is equal to, so 350, so that value will be equal to 5.38, okay, and this is in times value, okay, it's a ratio, just ratio. Then we have percentage return on capital employed. So let's calculate the profit, okay, profit, and then find from here. So the profit is going to be equal to, so profit is equal to revenue minus the gross profit minus expenses. So gross profit minus minus expenses. Okay, so that is equal to the gross profit we had calculated, it was 150. So 150,000, okay, 150,000 minus expenses. So the expenses include the bank loan interest which we have to remove. So 115 minus the bank loan interest was 10,000. So 10,000 you have to subtract. So that value is going to be equal to 45,000. Okay, so 45,000 is the net profit. So the profit is equal to, okay, the profit is equal to that is equal to 45,000 divided by, okay, 45,000 divided by, we have capital and non-current liabilities. So capital is going to be equal to 250,000, okay, plus non-current liabilities. Non-current liabilities are going to be the bank loan 200,000. Okay, so let's calculate this, and then this is a percentage return on capital employed. So you will have to multiply it by 100. So 100. So that value is going to be equal to 45,000 divided by 250, 450,000 times 100, that is equal to 10 percentage. Okay. So you can put even here thousands, it doesn't affect because the thousands will get cancelled. Okay. Next one is liquid ratio. Liquid ratio is current assets minus inventory by current liabilities. So let's calculate that. So the current assets, okay, the current assets are going to be equal to trade receivables, okay, the trade receivables which doesn't have inventory. So 80 divided by current liabilities. So the current liabilities are the trade payables and the bank overdraft. So 20 plus 50. So okay, if you want you can include thousands. This is a ratio, so you will have to write is equal to 1.14 is to 1. So this is a liquid test ratio, liquid ratio, asset test ratio. Then trade receivables collection period. Trade receivables times 365 divided by credit sales. So let's calculate that. So that is equal to, okay, it is equal to trade receivables were at 80, okay, times 365 divided by the credit sales were 80 percentage of, we have to just take credit sales, so 80 percentage of 500,000. Okay. So this value is going to be equal to 80,000, 80,000 times 365 divided by 80 percentage of 500, that is equal to 400,000. So that is equal to 73 days. Okay, this value is going to be equal to 73 days. Now trade payables payment period. Okay, trade payables payment period is equal to, let's calculate. We have written the formula, trade payables into 365 divided by credit purchases. So that is equal to, trade payables is around 20,000 in times 365 divided by credit purchases, only 90% of the credit sales you have to take, times 300. So that value is going to be equal to 20,000 times 365 divided by 90% of 300 is 270,000. So that is equal to 27 days.